Hi, this is Steve. Thought I'd give you an update on the market. It has been getting more volatile, and of course, I've discussed previously the problems that are coming out of the Middle East and Africa. So I thought I'd just show you a chart and give you uh, some of my thoughts on the situation in the market. Uh, on the screen, I have a chart of the SPY. That's the ETF that represents the S&P 500. And go back to on the left-hand side of the chart to September of '09 and to the right to present time. Uh, the S&P 500 daily prices are listed, or rather illustrated on the chart by the red and green. I have a couple areas highlighted. These were previous tops that preceded a correction or downturn. Uh, I've highlighted on at the tops uh, formations, and I'm going to discuss those in a minute. Also on the chart, I have an indicator called average true range. Average true range measures volatility. So as the volatility goes up in the market, this line goes up. And then as volatility comes down, that line goes down. Now, if we look at the date here, starting January of last year, rather, we hit a market top uh, right after the beginning of the year, and we can see if we look at the volatility began to pick up. That coincided then with the decline in the market. Then the volatility started to trend down, and the market trended up again. In April, just preceding the May 6th flash crash, we got an indication that volatility was picking up again. And we formed what I call a diamond top. Now, of course, we were out of the market, I think, on Luke Assets aside, maybe April 26th. And the market did suffer that market, we call a flash crash, on May 6th. We were able to avoid that, luckily. But you can see that the volatility picked up as in the market came down. The volatility began to subside once again. We chopped around, and in September, uh, Bernanke gave his notification that he was going to start to use a tool called quantitative easing, and I've talked about that before, and the powerful impact that has turned out to have. Anyway, the volatility continued to moderate, and the market moved ahead. Then we had a slight correction down dip in November. In December, it was off to the races again. And the interesting thing is, this was a very smooth uptrend that we enjoyed. And you can see how the volatility just came down in a nice smooth line and has continued until more recently. And this volatility began to pick up again. Of course, this is the time that we are experiencing or not we, but the Egypt problem and then the Libya problem. Uh, and so we've developed, what potentially could be here another diamond top. And this volatility is peeking over this average line that I drew across here that kind of coincides with the market downturn. So we're peeking over this line again. And this is reason for some concern. When you're trying to deal with the market such as we have right now, you have to examine it closely and take a look at things like volatility. Other factors come into play to make a judgment about whether or not we're topping right here for the moment. Investors Business Daily keeps track of something we call distribution days. A distribution day is a day that seems to represent institutional selling. It's a large volume down days. And when you have large volume, it usually it's an indication that the institutions are buying or selling. In this case, distribution, of course, means they're selling. The big players move the market, and so we want to pay attention to that. When we add all of the factors together and we come up with the evidence that begins to build the case that we are maybe uh, looking at a possible correction here. And if we can avoid a correction, that's I think that's good. It's always difficult to pick a market top, and I don't believe this is a anything more than a correction we're looking at because the trend is still from lower left to upper right. The bull market remains intact, but we are always going to have one, two, three corrections maybe a year. If we can sidestep it, I know most of my conservative clients anyway feel comfortable avoiding, a decline in their accounts by a substantial amount. So if this diamond top turns out to be like this one, we might expect the market to come down. The S&P 500 1300 level is represented by SPY here at 130. That's a critical line in the sand. That's our support. If we break that, then I would expect this scenario to play out once again. Consequently, and as the volatility is picked up, I have taken a more conservative posture on the accounts, and we have positions of gold, silver, relatively small positions. Timing appeared to be good to get into those. Also, I did buy some oil commodity related ETFs, and I took profits on one today. We still have a small position there. Oil did come down a little bit today, and the market sparked about 140 point rally in the market. The rest of the portfolio is in our flexible fixed income. We're about 80% invested. Those type of assets in the high yield and floating rate bonds kind of flattened out right now, but it's okay. We can stay there until we get some indication that the market may turn south. If the market does go south on us here, we're going to watch those carefully, and I will exit those positions as well if it starts to be too much of a drawdown for us. The core equity position, I have just two actually mutual fund positions. About 70% of the portfolio rather is in cash right now. I have moved some other assets out, and we are sitting on a pretty good sized cash position, and we'll just make adjustments as the situation becomes clearer. When you have up days that are up 140 points, down 200 points, up 100 points, this kind of volatility is somewhat unnerving, and it's not only unnerving, but it is when you add it as another piece of evidence, increased volatility is a sign of a top. Distribution days, you have 4 or 5 in a 4 or 5 week period. That's a negative, pointing to a market top. So a number of factors here are leading me to be a little bit more conservative, or I guess prudent and cautious